Hello, everyone. It's Friday, August 19th. Today on the final bar, we will wrap the week. We'll focus on how this week has evolved over the last 5 trading days, and we have a great amount to talk about. We had a sideways choppy period earlier in the week. We had a nice rally on Thursday's session, only to give all of that back and more on Friday. One of the weaker finishes to a week that we've seen in quite some time, with the major averages down over 1%, the Nasdaq down almost 2% at the close. Ladies and gentlemen, this is the final bar. Hey, everyone. Welcome to the final bar. Happy Friday. I'm the Chief Market Strategist at StockCharts.com in Redmond, Washington. Dave Keller is my name, and it's a pleasure to have you with us every day after the close for the final bar, particularly for a Friday when we get a chance to take a maybe relax, breathe in, breathe out, sort of cleansing breaths, and focus on what we've learned this week. If you get a giddiness and excitement in my voice as I'm talking about the market going lower, it feels good when all the technical signs point to a pullback and then the pullback comes out as you sort of describe it probably should. We talked about those conditions that have been manifesting themselves in recent weeks, right? The market obviously pushing, quickly off of the June lows, but then pushing even more and more to the upside, becoming overbought. Now, broadly speaking, while that's encouraging to see stocks being overbought, because that usually only happens in a bull market phase to have things go up that much, the challenge is it certainly puts a lot of pressure on names that have been leadership to maintain those uptrends. And we've hit key resistance level stocks like Apple and many others, which we've reviewed on the show, all pulling back today for the most part off of those resistance points. We'll get to the charts here in a little bit and review all the evidence together. I do want to let you know about the schedule coming up. We had a couple of really good guests today, thought-provoking guests. David Hunter on Wednesday talking about an aggressive upside target for the S&P and an aggressive downside target for interest rates was certainly a notable one among others. And I'd again encourage you to check out all of our previous discussions. Coming up next week on Tuesday the 23rd, Craig Johnson from Piper Sandler. On Wednesday the 24th, David Auerbach, editor of the Daily REIT Beat. And then on Thursday the 25th, Tony Dwyer, chief strategist at Canaccord Genuity. Other couple quick events to let you know about coming up very, very soon. Next Tuesday, I'll be doing the next webinar from Market Misbehavior. It is called Seasonal Struggles for Technology. This is on Tuesday, August 23rd at 1 p.m. Eastern. Free event where we'll talk about the seasonal challenges for the S&P, for the Nasdaq, particularly for the tech sector over the next 4 to 6 weeks. Really important time to think about some of those seasonal trends and the evidence we're seeing now versus previous years. Go to marketmisbehavior.com/technology to sign up for that free event. Also, ChartCon is on the books and it is coming. We are going to have a fantastic 2-day event for you, a virtual event, October 7th and 8th. We are flying in a group of fantastic presenters to our new studio in Redmond, Washington. They will be sharing with you expertise, lessons learned in 2022, a lot of forward-looking discussion about what to come. We're going to have bull bear debates. We're going to have market outlook panels, fireside chats with some fantastic analysts and educators like Ralph Acampora, Mark Chaikin, Gaddis Rose, John Markman, Martin Pring. It's going to be such a fun time. You can sign up for that event, stockcharts.com/chartcon. I would strongly encourage you to check that one out. It's going to be an absolute fantastic time together. Let's continue on today's show as we wrap the week. What we like to do on Friday is just look back over the last 5 trading days, see what we learned and what kind of information we can find. I did want to start with a poll that we had running recently on our live stream page at stockcharts.com, also on social media. So make sure you follow us on Twitter. Make sure you subscribe to our YouTube channel. You won't miss the next poll. We asked you recently, which of these is most likely to happen before December 31st, 2022? So between now and year end, which of these is most probable in your opinion? The S&P breaking above 5,000, the S&P going below 3,600. So basically a new all-time high for the S&P or a new 2022 low for the S&P. The next ones are Bitcoin above 40,000, which would be quite a rally from where we're at now, or Bitcoin below 15,000, which makes a new low for the year. 50% of you, just under that, 49% said S&P getting above 5,000. That is a broadly bullish take from Final Bar Nation on that one. I'm surprised only 25% of you said the S&P making a new low, right? Talk about an out of consensus outcome. And that immediately makes me think, while the market is certainly pricing in the likelihood, like many of you, thinking the S&P could get above 5,000 before the end of the year, it tells me to think about some of those other scenarios, particularly the S&P making a new low. Is it likely? I'm not sure at this point. I haven't seen enough to tell me that that's a likely scenario, but I certainly know that any of those four are possible. And the real game, folks, is to think about each of those four scenarios. Think about what your portfolio, your holdings may do in each of those four scenarios. That's what institutional investors, that's the professionals, would certainly do given these conditions. Continuing on to wrap the week here, we have a couple things we'll do. We'll start just looking at what happened today on Friday the 19th. We'll then look back at the last 5 trading days and see how today fits into that broader movement over the 5 days. What did we actually learn about these asset classes? Then we'll go through the Mindful Investor Live chart list, get through some of those charts, talk about price, breadth, and sentiment. A lot to get through, and let's start here. The S&P today closing just above 4225. That's down about 1.3% from Thursday's close. The Nasdaq Composite down a little more, down 2% once all was said and done, right around 12,700 for the Nasdaq. The VIX, by the way, bouncing higher, and this is one of those charts we've talked about a lot in recent weeks. I've mentioned a number of times the VIX hitting 20 has often been where the market has topped out. I am not surprised to see the VIX bouncing off of the 20 level and seeing stocks pull back from that point. Now, the question again is how far and how long would any sort of pullback exist? And that's what we'll start to look at some of that evidence here in a few moments. Briefly on other asset classes, interest rates moving higher today, and that was really a big part of the story here. 10-year yield getting closer and closer to that 3% level, which it's been below for quite some time. 30-year yield, long bond yields getting above 322 today. The dollar index pushing higher as well. So stronger dollar, higher rates, certainly buying or sort of playing into that weaker growth narrative, which is what really caused the markets to pull back today. Commodities overall very, very mixed, but gold and silver certainly feeling some weakness, along with energy, although it's sort of flat, not too painful for the day. Speaking of pain, cryptocurrencies are there. Bitcoin down 8%, Ether down 8% as well. Bitcoin back down to 21,350 or so as we're going live with the show. Talk about a rotation lower, and what concerns me about this pattern, where you've seen a number of times where Bitcoin, where Ether, Litecoin, others try to mount some sort of rotation to the upside only to stall out and then have these big down days like this. That concerns me about the sustainability of the risk on trade, because while cryptos and stocks don't certainly or necessarily move in a one-to-one, perfect positive correlation, there's certainly evidence that backs up the fact that Bitcoin and Ether certainly are sort of a risk asset, right? They go up in bull phases and they go down in bear phases. A great representation of overall investor psychology. They're going down in a big way today, which concerns me again about the upside potential for some of those major other risk assets like equities that we've talked about for some time here. Let us look at the wrap the week chart. So what we do here is just look at the last 5 trading days. I'm going to look at this one first because we had a little issue with cryptos that is going to skew the chart just a little bit. So if we look at this one, here we go. We've taken Bitcoin out of the list. We're starting the clock last Friday, the 12th. We're going to today. What happened in these major assets? Here's the S&P finishing the week down 1.2%. Now, it was actually net positive for the week as of Thursday's close, with that nice bounce going into Thursday's afternoon. Today, giving all of that back and much, much more, finishing at the lows for the week, essentially. Very, very similar return would be crude oil prices down 1.2%. After that, it gets a little worse here. Bond prices using the TLT down 2.2%. Down 2.3% is the Nasdaq 100. Here we have small cap stocks and EM, emerging markets, both down about 2.8%. And then gold, the worst performer of the bunch, down 3.1%. I don't talk about gold and gold stocks very often on the show. And anytime I do, it's just to remind you they're still going down. If you would buy them in this sort of moment, you are buying them, as far as I can tell, purely because they've gone down a lot. And that's never a great argument, a great justification for buying something, in my humble opinion. Now, a couple things actually outperformed. Only one of them that we can highlight, the dollar index, which was up 2.4%, or using the UUP, which is a bullish dollar ETF, as a proxy for the dollar index, but pretty matches pretty closely, particularly in the short term. So sort of the dollar going up and everything else going down. Now, that has been a big part of the story for most of 2022. Mid-June to mid-August has taken a big break from that thesis, but the way this week ended, it certainly gave the hint that this is just the beginning of further dollar strength, a further weakness from some of these risk assets, which certainly could cause some challenges in areas of the market that have had really good runs. Speaking of which, there's Bitcoin, adding it to the list, down 11.4%, by far the worst performer of the bunch. Let's finish off today looking at the wrap the week, or excuse me, the Mindful Investor Live chart list. But I did want to mention sector returns here very briefly. Healthcare did net a positive day today. It was up 0.2, 0.3%. Not bad. I mean, obviously, it's good that it wasn't down along with everything else. Energy was flat along with utilities. Everything else was essentially weaker. I'm going to highlight one particular pattern here, which is the XLY was down 2%. The XLP only down about 1/3%. That ratio of consumer discretionary versus consumer staples is an important one. I don't know if we're going to get to it here in our Wrap the Week segment, but we were certainly going to talk about it in the 3 and 3 because it's one of the charts that I selected for that review. Just to finish off here, we're looking at the Mindful Investor Live chart list. This is a list of charts that I keep updated at StockCharts.com. You can go to my blog called The Mindful Investor. It's on the articles tab on our website, and you'll see a link at the top of that page with all of my articles to get to this list of updated charts. My market trend model is on 3 timeframes: long-term, medium-term, and short-term, all driven off of weekly data. Even with the weakness we saw going into the close today, my short-term model still bullish, my medium-term model still bullish, and my long-term model still very much bearish. So no change. Now, again, one day usually doesn't move. These are based on longer data sets. So if this would continue going into next week, there could be an opportunity for the short-term model to turn back negative. We'll have to see what happens there. Looking at a daily chart of the S&P, this blue shaded area is when we focus a lot of our attention on leading up to the breakout there a couple of weeks ago. This was based on the highs from June, and noticing the fact that the S&P finally got above that resistance level. From there, we approached what we called the final resistance, which is the 200-day moving average right around 43.20, as well as the 61.8% retracement, which is a little above there around 43.70. At this point, it certainly looks as if we have traded up to the 200-day. That was on Tuesday, and from there, we've rotated lower. Now, what's fascinating about that is that lines up with an overbought condition. Stocks like Apple overbought as they hit all-time highs, now pulling back. So the scenario we talked about, that we described, which was we run up to these resistance levels, a lot of stocks texting the 200-day. The question is, do they have enough momentum to get above there? The fact that we're overbought makes me question the ability of the markets to power through there. And for what I'm seeing so far, it certainly seems like a brief drawdown at least is likely to continue going into next week. Now, having said that, where do we go from there? My conversation yesterday with Jeff Hughes is a good one to review. And if you missed that, I thought I did a really good job of talking about potential binary outcomes. What would you need to see to turn negative on stocks? What would you need to see to sort of validate further upside? And I don't disagree with some of his take. Now that we've had this run, the question is, what's next? We could hold 4,100, which would be the 38.2% retracement level. That's basically this orange, reddish shaded area. We hold that. This isn't bad. This is a brief pullback that could then reaccelerate to the upside. We break that, though, you will immediately hear me talking about retesting the lows, talking about downside potential for risk assets, stocks and cryptos, certainly the likelihood of further upside for the dollar and for interest rates, because that would complete that thesis of weaker stocks, of weaker growth stocks for sure, and stronger other parts of the market. Now, the breadth picture overall is still very constructive, and I think that's one of the reasons why we've rotated our perspective from very bearish back in June to less and less bearish, now a little bit constructive, particularly in the short term. It's because the breadth conditions have been so positive. And when these 4 cumulative advanced decline lines all got above their June highs, that certainly seems to be constructive. What would cause this to be negative? Well, they fail and they go back below those breakout levels. That's sort of what I would be looking for here to see what plays out. Finally, and then we need to wrap, the fact that the S&P stocks above their 200-day has stalled out right at 50%. Boy, that would be incredibly poetic if the market pulls back aggressively from here, because that is a key breadth indicator remaining in the bearish territory despite the rally June, July into August. Let's take a quick commercial break. We'll be back with my next segment, Power Up. We'll see you in a minute. Hey, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you so much joining us every weekday after the close for our show. A couple quick announcements before we get to my next segment. First off, we welcome your questions. We're going to do a mailbag segment here in a few minutes, and we would love to feature one of your questions in our next mailbag, which will be Tuesday of next week. You can get your questions to us one of three ways: via email, thefinalbar@stockcharts.com, on Twitter @FinalBarSCTV, on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air Tuesday of next week. Also, go to StockChartsTV.com. We have so much great content on there. Our team does such a good job gathering expertise from all of our contributors, doing special events like The Pitch, our mid-year market outlook. So much more is all there for free for the taking at StockChartsTV.com, or on your mobile device. Just search for StockCharts TV on demand. Our next segment is called Power Up. What we like to do on Friday is just upgrade your familiarity or usage of the StockCharts platform. There's so many great hidden features and new features that are being added all the time. And we want to highlight some of those just to help you get the most out of what we feel is a very rich and deep analytical platform. We're going to talk about performance. And one of the cool things that we added recently, this is in our previous release, I think it was the Alki release, if I remember right. All of our releases are named after geography in Western Washington. So we had a performance view for our chart list within the StockCharts engine. So if you bring up any of your chart lists, you will have the ability to view your list as summary, a chart book, a candle glance, but you also have a performance tab, which allows you to show tabular data looking at performance. Right now, I'm comparing all of these stocks relative to the S&P 500, and I'm showing in descending order what the year-to-date relative performance has been. Think about the possibilities to compare these different stocks, different ETFs, different benchmarks, look at different time periods, and really understand which stocks are working, which stocks are not. Obviously, also works for ETFs and other asset classes. The new release here with our Bainbridge release allowed us to incorporate that into our ACP platform. ACP, I don't show enough on this channel or on my show, and I 100% get it. I will try to do better at showing both sharp charts and ACP. That's on my list of Dave Be a Better Host, which is a long list. I'll be honest with you. But what I wanted you to know is below the chart on ACP, you have this little table down at the bottom. You might not be able to see it, and if not, hit this little arrow key or the side. There's a little panel button that'll open it up for you. Once you do that, it will bring in a chart list that you select above there, and then you can pick different items on here. When I select performance, I have that same performance capability. So what this allows you to do now in the sharp charts world, in your chart list, but also within ACP, look at performance across different timeframes, and then immediately go to the charts that will help you tell those stories in the chart above your table. That is our segment, Power Up. We need to continue on today's show and answer your questions from the Final Bar mailbag. As a reminder, keep your great questions coming to us. If you can, always include a chart link or an image so we can see exactly what you're talking about. Always makes it easier. Here's question number one. I see a lot of interesting parameters being used in the charts. For example, AAIIBULL and bear. Where can I find more information on parameters to use? So here's the good news. The good news is anything you see someone like me showing on StockCharts TV, we probably are more than happy to share that with you. And that is a standing offer for anything that I show. The chart that you're mentioning is one that I refer to when I talk about sentiment. I have this chart that I like to share with you that shows AAIIBULLs and bears, and I show it as a histogram where one of them is positive and the other's negative. That's a really cool way, I think, to visualize data like this. And years ago, Art Hill showed me a number of tricks to try to make the histograms and make the charts appear certain ways that can be really, really powerful. There's a way you can do that, and if you hit pause, you can see the arguments that I use below to create that using indicators like price, up, down, pair. But here's the great news. Anything that I show on the show, just email me at thefinalbar@stockcharts.com. Let me know exactly what the chart is, describe it as best as you can, or tell me what episode you're watching and what moment, what minute that you're watching the show. I'm happy to send you the link. You can copy it right to your own login. Now, we don't have a great central repository for all these things because we have a ton of breadth data, a ton of sentiment data. It's all over the place. All I will tell you is keywords can be your friend. If you type a word bullish, you'll see a bunch of things. In this case, bullish percent index that dominates the results here. If you don't see what you're looking for, the little message below there says more results, and you have a bunch. It's a keyword search that's pretty smart that allows you to go through a lot of the data. I was talking with Julius DeKempener, who's part of the StockCharts family, and we were talking about some ideas about better organizing breadth and sentiment indicators and giving you a place. So we actually are in the process of creating a breadth homepage and a sentiment homepage. So soon enough, I'll be able to share with you some really cool ways to visualize those a little more effectively, or ways to identify what parameters we have available. I would use the keyword for now. Next question. If in my investment time frame, the weekly chart flashes a buy, should I just buy on that Friday? Or should I use a daily chart trying to optimize a purchase in the next week? And you mentioned in particular, the person asking the question, you're only interested in buying indexes. But again, this certainly could apply to any asset class, to be honest with you. And that's a really good question. Let's say you see a pattern. I'm just bringing up a random stock here. Here's UNH. This is my standard weekly chart. Looking at about 7 years of data, weekly data, moving averages, momentum, and relative strength. So let's say you're looking at the chart of UNH. It certainly looks to be hitting a new high, and you think, all right, that's a great time. So here's the thing. The short answer is it depends, of course. The longer answer is it really depends on how aggressive or how conservative you want to be. What you have to remember is there's no one way to use a chart like this. And this is why there's not like one indicator we all use as technical analysts. There's no one point where we all of a sudden are all making buy and sell decisions. The way we analyze data, the way we set up our charts, the way we interpret them, and most importantly, the way we take action when the chart determines that it's time to do so, it can all be very, very different, right? And just the questions we are trying to answer as investors, our goals as investors may be very different as well. Having said that, I think you're suggesting in your question a really thoughtful way to think about multiple timeframes. I often think about the weekly time frame as the way to set the stage, help me understand the big picture about the trajectory on the stock. In this case, I can see that UNH has had a pretty good run over the last 7 years. I can see that on a relative basis, though, strong relative gains in 16, 17, and 18, really a market performer over the last couple of years. But 2022 has been very strong for this particular stock. Then maybe I can go to the daily chart and actually see what's happening. Here I can really focus on what's happening as the stock attempts to make a new high. I can look at the momentum characteristics, really drill into the relative strength performance, look for key support and resistance levels, maybe identify a pullback or a potential pullback to a moving average that may give me a better opportunity. And so that's what I would do. In an ideal situation, you use both a weekly and a daily chart. And again, on a 30-minute daily show, I don't get to get into too much of my particular methodology of how I would actually trade some of these charts, because I'm trying to get through different narratives and get through different charts to illustrate the technical perspective that we're trying to advocate. However, I would tell you there are a lot of great resources out there, and I think a lot of our StockCharts contributors do a great job of really showing you how they would pull the trigger on particular charts. Aaron Swenlin with their trading room, Joe Rabel with his Q&A show every week, Stock Talk with Joe Rabel, Dave Landry, their 3 shows in particular stand out as ones where they really demonstrate buy and sell decisions. Mary Ellen McGonigal is another good one as well. Next question, are the Sector SPDR ETFs, XLY, XLK, et cetera, good for trading short term? The short answer is absolutely. And what's really funny about it is if you look at the history of ETFs, I remember, and this was like early 2000s, I want to say it's a blur of sorts, that sort of period in my career, I guess. I just moved to New York. I started at Bloomberg and was overwhelmed. I was in the deep end, I feel like, with working with the financial markets, a lot of really smart people around me, but it was a fantastic learning experience. And I remember ETFs were still very early, and institutional investors, which is what I worked with primarily, were really not 100% sure how they would be using them because they were really designed for retail investors. And to be honest with you, in a lot of ways were meant as short-term trading vehicles. Over time, it's evolved quite a bit, right? Remember early on, there were not very granular ETFs. They were more broad, like sectors and indexes, right? The first ETFs were tracking broad things like the Nasdaq, right? The Nasdaq tracking stock is maybe the first one that I can think of. The spiders and others obviously came after that. But then they became more and more granular. You have active ETFs, you have commodity ETFs, currency ETFs, ETFs not holding underlying assets, but driven by derivatives, swaps and such that allow you to mirror, do inverse or leveraged returns to different assets. All those things came later. And I would say in general, those more exotic structures are really more designed, they're really optimized for trading short term. They're not very good for holding longer term. Leveraged ETFs really are designed to hold long term. You're kind of taking on a lot of risk in terms of how they're constructed if you would do so. The ETFs you're asking about, the major index tracking ETFs and sector ETFs, absolutely can be valuable as a short-term trading vehicle because the spreads are so short, the expenses are very low, and they're very liquid. And that's what you're looking for when you're trading short-term. The good news is they're also very good for holding longer-term, right? So if you want a sector rotation strategy based on charts, based on the RRG, for example, and you want to use 11 ETFs that are pretty liquid, the spiders do very, very well on multiple timeframes. Final question, then we got to wrap the mailbag. How can I find ETFs with improving relative strength? Two things that come to mind, and I really appreciate your question. I'll give you the quick version. Number one, I think our scooter reports are really, really good for that. If you click on charts and tools, go to scooter reports, and then all you need to do is at the top, switch the universe to US ETFs. You can look at the scooter rankings in descending order, which is where we start. You can look at strength and weakness, but you can also look at changes. So you can see which ETFs are fluctuating. Right now, I'm looking at an intraday, but I could say end of day, I can look at 1 week returns and see when which of these ETFs are rotating positive or negative. Now, this tends to include things like short ETFs, leverage ETFs, because it's a big universe of ETFs that we track. So what you might want to do is make a chart list of ETFs that are more in the, if you have a particular list, like look at the iShares ETFs, look at that whole family, you can copy and paste those tickers into a chart list and then use the summary page or the performance page to really understand the performance characteristics and see which ETFs are doing better than others. Other thing I would say, by the way, is use our scanning engine. I don't have time to get any more into this, but I actually have a scan for stocks or ETFs making new 65-day highs and new 65-day lows for exactly that reason. I want to know ETFs that are having improving relative strength and declining relative strength, and looking for new swing highs and lows has been a really good way that I've been able to do that over time. Great mailbag, guys, and thank you so much for those fantastic questions. Keep them coming, but we need to wrap the show and wrap this week. Let's talk the 3 and 3. 3 charts in 3 minutes that tell the story of this market environment. And here is chart number 1. I think it's a really, really important one. The XLY, the XLP is what I call the offense versus defense ratio. This is key because it tells you where investors are rotating to the more offensive side of consumer or the more defensive side. To put a little more simply, are people rotating to things you want, which is discretionary, or things you need, which are staples? And that tells you a lot about the risk appetite and consumer behavior. The cap-weighted version, which is overweighted on things like Amazon and Home Depot and Tesla, broke out above its June high in late July and has made a new swing high, but starting to rotate lower, obviously going into the close of the week. The equal weighted version still has not broken above the June high. When I'm thinking of the bear case, when I'm thinking of the uptrend is exhausted, this is the end of a rally phase before we roll over and maybe even test the lows around 3,600 or lower. This sort of chart gives me a little more conviction in that thesis because it tells me that even though we've had a nice run, defensive stuff is actually still holding in there just fine. Chart number 2 is interest rates in the form of $TNX. This is the 10-year U.S. Treasury yield index. It's basically the 10-year yield times 10. That's how the CBOE quotes this index. And what I wanted to highlight here is in August, rates have been going higher. We've been talking about how the market has rallied June, July, and August because rates have come down because of lower interest rates. And overall, that's true, right? The longer-term trend in rates has rolled over. You can see the slope of the 50-day moving average coming down over the last 6 weeks or so. But in the month of August, actually, rates have been going higher. The 10-year yields have increased. There's a possibility the 10-year yields go even higher, above 3% to 320, 340, 350. What would that do to value over growth, which is this series at the bottom? And I tell you, the short answer is value would outperform, and it would be hard for the benchmarks to do well, given their overweight in growth names. This leads me to my final chart, which is the most important one I'm probably going to show you in the entire 30 minutes, the bullish percent index on the Nasdaq 100. I showed you early this week, and I told you this had gone above 70%, and I would let you know when it got back below 70%, because those have been the major tops so far in 2022. It happened today at the close where we got back below 70%. That tells me expect weakness going into next week. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close. All of our previous episodes and some fantastic interviews are at StockChartsTV.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.